and welcome to Moneylife. This is Sucheta Dalal. This week, let's talk about the exit of HDFC Bank's chairman and what he did to the HDFC Bank stock. This is a blue chip stock in all portfolios and it's sort of crashed over two sessions. Now, in banking, confidence can evaporate faster than capital. And this is the point that was driven home on 18th March when Atanu Chakraborty issued a cryptic resignation letter. He was HDFC Bank's part-time chairman, and this triggered a sharp market reaction, raising legitimate questions about board processes, disclosure standards, and market sensitivity. Now, what did he say? And who is he? Mr. Chakraborty is a retired IS officer who has served on the board of the bank since 2021, and he resigned citing certain happenings and practices within the bank which he said were not in congruence with my personal values and ethics. Now, what does anyone think when they read that? That there's something dramatically wrong in the bank. He offered no specifics, but the board had to convey it to the stock exchange. Didn't stop at that. There was a change in management and a lot of action. Obviously, depositors and investors were petrified. Now, the media was after the board and the chairman. So he, in a televised interview, later clarified that there was no wrongdoing and there were only ideological differences, which means he is backpedaling within a few hours. The sharp contrast between a resignation letter citing ethics and the later statement saying no wrongdoing was highly unsettling. But more interesting was the reaction of the Reserve Bank of India. The damage to the bank itself was immediate. HDFC Bank shares fell nearly 9% on 19th March. The decline extended over the next few sessions. The overall drop was about 12%. It's only on 24th March that there was a slight recovery, and more on the 25th and the market went up. The episode erased 1 lakh crore in market capitalization at its peak and reminded the market of how quickly sentiment can shift in any large blue chip stock. And this one carries significant weight in the Nifty 50 as well as the Nifty Bank Index. Now, Reserve Bank of India, I said, behaved unusually. It issued a very prompt and strong reassurance which said there were no material concerns on record as regard the bank's conduct or governance. Simultaneously, it approved the appointment of Keki Mistry, an HDFC veteran, as interim part chairman of the bank. Now, the episode has definitely invited scrutiny and debate. The bank was on conference calls immediately with investors, large investors, and the media, and the managing director, Shashi Jagdishan, followed this up with fairly combative interviews, again unusual, which sort of helped stabilize sentiment. But if you ask me, the damage was done, and this issue ought to trigger a bigger governance debate. Now, let's look at two sides. One, resigning from a high-profile, well-remunerated non-executive role on ethical grounds is definitely rare in the Indian environment, where directors are known to ignore red flags and whistleblower complaints. This has happened most dramatically, of course, in infrastructure leasing and financial services. This massive conglomerate of 340 companies. In 2018, when IL&FS, the holding company, began to default, it triggered a systemic shock. And what did we find? That the Reserve Bank of India, the directors, very, very high-profile people on layers of holding companies had ignored whistleblower complaints and much else, including manipulation of accounts. So when Atanu Chakraborty resigns, obviously there's a lot of governance experts praising this to the skies. But logically, a resignation which is framed in ethical terms has to be supported by specific concerns, not just in a resignation letter. They have to be tabled before the board, minuted, and there has to be something to demonstrate that the board overruled him or ignored what he said or demanded that we want to be the bad guys and won't listen to what is good and ethical. Nothing of that sort has been put on the table. So how can a one-line resignation be all right, especially when you're talking about a bank? And here you have the chairman who's walking back on the gravity of his charge within hours. Now let's look at a what-if scenario. We're not talking about any company. We're not talking about some manufacturer where the impact will be much later. In a what if scenario, if the abrupt resignation had triggered even a small run on deposits, the consequences could have been serious for a bank of HDFC size and importance. It's called a systemically important institution. And this is no joke. Forget about small, it could have been really big. First of all, a 12% drop in prices is no joke. Now, the run on deposits didn't happen because people probably were waiting to see what happens. But in 2023, this has happened, and I've done a blog about this with Silicon Valley Bank, which collapsed because 42 billion just flew out of the bank on a single day through apps and group chats. And all the panic was amplified on Twitter and on social media. So you didn't have depositors thronging with queues, moratorium, not the kind of situation you see in India. It just silently went out online. We have the facility and the technology for that to happen today. You have UPI, you have IMPS, you have NEFT, you have near instant bank transfers, making private sector banks particularly vulnerable and exposed to this shift in depositor confidence, which can be triggered by thoughtless actions of the kind which I think Mr. Atanu Chakraborty took. More importantly, this is not the first time. The last time it was triggered by the Reserve Bank of India. In December 2021, RBI abruptly decided not to extend the term of Vishwavir Ahuja as its long-serving managing director. He announced this on a holiday on Christmas morning, including some kind of succession. I'm not going to go into it. There's a separate video blog, but it sparked similar fears. And on Christmas Day, the media and analysts were all online wondering what is going on. Run on deposits did not happen precisely because it was a holiday and because people came out a bit in support of the bank. But remember, RBI then, before Monday morning, issued a reassurance about the bank's financial health. That time too, I had asked, how on earth can a regulator behave in the manner that Mr. Atanu Chakraborty has done now, triggering possible panic in a sensitive banking institution which affects investors as well as depositors. Now, these are two episodes, RBL and HDFC. So, two is enough to worry about a trend, and it underscores the need for greater care in how sensitive information is communicated. When you talk about systemically important institutions, it's not just about reporting, it's how people on their boards as well as the regulator also behave. And you know why this is important in India? Because every time you see a bit of smoke, there is a fire. And you have seen accounting irregularities so often. Most recently, IndusInd Bank 2025 significant balance sheet adjustments, leadership exit, fraud. It is still being investigated by SEBI, which has even acted on insider trading allegations. Then IDFC First Bank, 590 crore suspected fraud in one branch at Chandigarh. But until the bank came out in the open, it did not affect the bank, but it was worrying. The bank quickly did a forensic audit, suspended staff, cooperated with investigators, made good the money, and had settled all the claims of 645, which is crore, which is mainly to the government. And nothing further has fortunately been found as yet. So deposits have remained stable. But the episode added to investor nervousness about operational controls at private banks. Now we hear there's another one happening at Kotak Bank, relatively smaller. So, in fact, barring RBL and HDFC, bad news and smoke and rumors has usually meant that there has been a fire, and all of us, Aam Aadmi, are justifiably panicked when it happens. The damage that has been inflicted in the past on investors, depositors, and bondholders has been pretty huge. The collapse of IL&FS in 2018 was quickly followed by a series of failures. Diwan Housing Finance Corporation, Housing Development Infrastructure Limited, HDIL, Yes Bank, PMC Bank, Lakshmi Vilas Bank. Every case was one of systemic fraud and governance failure, which had been ignored for far too long. Fortunately, this does not happen in public sector banks because they're owned by the government. So even when net worth has been eroded in the past, people don't withdraw deposits because Sarkar hai. The world has responded to what happened in Silicon Valley Bank. So, global norms increasingly demand prompt factual disclosure when directors resign over disagreements. The United States, the Securities and Exchange Commission, requires detailed 8K filings. The UK, which has a Financial Conduct Authority, expects immediate and precise market updates. India's regulatory framework still permits a degree of ambiguity that markets can punish very swiftly, as we have seen with the collapse of HDFC Bank. In this case, the whole issue seems to stem from interpersonal friction and differences that the management has described as being blown out of proportion rather than from material fraud or ethical violations. The managing director said, "Yes, I disagreed with the chairman, and that can't be a problem. It makes it healthy and democratic." The bank has now appointed external law firms, domestic and international, to review the resignation letter and the relevant board minutes to see who's telling the truth. SEBI has also indicated that it will examine the matter, including governance aspects as reflected in the minutes, and it has sent a broader message that independent directors must act responsibly and avoid unsubstantiated insinuations. These steps are welcome, yet the episode reinforces an important lesson. Twice in 5 years is twice too often. Abrupt signals from regulators or board leaders without adequate context impose an immediate cost on the system. So RBI vets every private bank chairman. It may wish to consider whether all appointees and regulatory officials handling such posts would benefit from explicit briefings, I would say even trainings, on market sensitivity protocols and communication discipline. Banking is built by trust, and it takes decades to build it, can be shaken in minutes. The lesson is not that independent chairman should remain silent. This is the last column that would prescribe it. But if they choose to speak, especially through a public resignation, it must be done with precision and evidence, or the entire ecosystem bears a cost. Greater clarity in disclosure, measured regulatory signaling would serve market stability and lead to genuine governance improvement. Thank you.